So, what is standard costing and what's its purpose? Basically, think about a company which produces the same type of product over and over and over again. Given the fact that the product's design doesn't change, it's more or less uniform and they're producing it over and over again, they should in theory be able to come up with an estimate on how much material is used each time, how much labor is used each time, how many overhead costs are incurred each time. And if they do this, they can set a benchmark or a standard of how much cost, how much material cost, labor cost, overhead cost they expect to incur for each unit produced. And that's where the concept of standard costing comes in. For example, let's say you have a beverage company that produces all these different types of drinks, and it is able to estimate the cost of a single unit of cold coffee, a can of cold coffee that it produces, right? So it estimates that it can use 300 grams of direct materials such as milk, sugar, etc., coffee, at $5 per kg on average. It estimates that it requires 1 minute of direct labor, and labor is paid at $60 per hour. It estimates that each can requires overheads or machine time of 1 minute, and those cost around $90 per hour. Based on that, it can come up with an estimate. So 300 grams into $5 per kg, a total cost of $1.5. 1 minute into $60 per hour, a total cost of $1, right? 1 minute into $90 per hour, a total cost of $1.5. Added up, we expect an average can of cold coffee to cost $4 to make. And this whole thing is called a standard cost card, where you have the breakdown of your different costs, the calculation numbers involved in it, as well as the final numbers as giving us the cost per unit. Okay? Now, the $4 is called the standard cost per cold coffee unit. What was the point of doing this exercise? Well, standard costing is a technique that can be used in both management and financial accounting. So firstly, let's talk about financial accounting. Standard costing is an inventory valuation method, which can be used under both the IFRS and US GAAP standards. So think about other inventory valuation methods, FIFO, LIFO, weighted average, etc., right? For them, as you'll be familiar, there are certain calculations that you need to perform in order to do them properly. But with standard costing, the calculation becomes much simpler, because let's say you produce 100 units of cold coffee. In that case, the cost would be simply 4 into 100, $400, which you can show as the value of your inventory, right? The calculation becomes much more simplified. Now, the astute amongst you would say, but hang on, just because we're saying or we expect that an average can of coffee will cost us $4 to make doesn't mean that's going to be the actual cost in real life. And you're absolutely right. There's no guarantee we'll be using 300 grams in each and every unit, or it'll cost us $5 per kg in each and every unit. That will take 1 minute for each and every unit, right? There's no guarantee for any of this. This is just an estimate, right? And an estimate by its very nature can never be 100% accurate, especially when taken across all these multiple units that we'll be producing. But that actually gives us the second benefit of standard costing for management accounting, that it can be used in something called variance analysis. See, what will happen is we have our cost of $400, the standard cost. Then we'll see how much it actually cost us to make those 100 units. Maybe it costs us $450. So there's a $50 difference. So normally what would happen, we'd just record the cost of $450 and be done with it. But now we have the cost of $450 and the cost of $400, as well as the variance between them of $50. Furthermore, we'll be able to break down both these costs and see, okay, we said we would use 300 grams per unit. How many grams did we actually use? We said it will cost us $5 per kg. How much did it actually cost us? By comparing the actual values to our standard values, we can actually conduct variance analysis at a much deeper level for direct materials, their cost as well as their quantity. For direct labor, their quantity and cost. For overheads, their cost as well as their quantity. So, and this will give us a lot of insight in where we're incurring more cost than expected or less cost than expected. And we can look into those variances to see which areas we need to improve on. So there's that. Then, as you've seen, basically we'll be using our standard costs as benchmarks to compare the actual cost against. So this will also mean that they'll serve as targets or budgets for our organization. So the values from the standard cost card would also be used to prepare budgets, like the production budget. You'll say, okay, if we want to produce 100 units, we'll need to have 100 into 300 grams, this many kg, right? 100 into 1 minute will need 100 minutes of labor time, and so on and so forth. So you'll be able to prepare budgets for production, for direct materials, direct labor, and overheads, right, based on these standard cost cards. Now, that's an introduction to what standard cost cards are. There are a few more things we need to be familiar with. First of all, when it comes to standard costing, there are four main types of standards that you could have. The first one are attainable standards, which, as the name implies, are those standards which can be achieved. They can be achieved through efficient but not perfect operation. So these would be standards where you expect some normal losses, some downtime. So you expect workers to maybe not work for 100% of their hours during the day. Obviously, they're human beings. You expect some downtime of maybe half an hour, 1 hour, etc. These standards are there to motivate staff to work harder, but they're an attainable standard, so they're a bit high in that they'll push and challenge the staff, but they're not so high that they'll demotivate the staff, right? They'll just be there to constantly push staff to improve more and more. Then you have your basic standards. These are your long-term standards which will remain constant over years. And they are there to show trends of how things have changed over time. So these standards will be set and they'll be applied, for example, for a 5-year period. And then you'll compare the standards of that at the end of that 5-year period to these basic standards to see how prices have changed, how usage of your products have changed, right? And so on. You have your current standards, which obviously, as the name implies, are the most recent ones, which are based on your current working conditions, and they can be set to accommodate specific circumstances. So maybe during the year something happens, there's an economic recession all of a sudden, you will need to revise your standards, maybe reduce your cost or reduce your prices and so on. So that's where current standards will come in. The risk, of course, is that they will encourage a status quo and might not motivate the staff to improve. So if you're constantly updating the standards to account for different situations and constantly revising them, most likely downwards, then you're not really pushing staff to try to beat the circumstances and actually do better than expected. And then finally, we have the last kind of standards, which are the ideal standards. Okay. Now, what are the ideal standards? As the name implies, these are based on an expectation of perfect operating conditions. There's no allowance for losses, breakdowns, or downtime. You're expecting workers to be working throughout the day, machines to be working perfectly throughout the day. So these are primarily there to highlight the areas in which the company is underperforming based on the magnitude of variances. So of course, you'll never expect to achieve these standards, and you'll expect certain variances from them. But if the variances are particularly large, it will show in which areas you're lacking, right? So if material and labor variances are relatively small, but overhead variances are large from these standards, you can immediately see, okay, you're doing well in material and labor, but not so well when it comes to overheads. Of course, the downside is if these are used to push staff, they might become demotivated, knowing that these standards can never be achieved anyway. So it needs to be made clear that these are not what are expected to be achieved. It's just they're there as the ultimate benchmark to compare against, and you need to constantly be pushing towards these. While standard costing, as we've seen, has various benefits like we highlighted, it should be noted it's not always ideal. It can work well for entities which produce massive quantities of nearly identical products. So a can of cold coffee would be identical to the other 1,000 cans that are being produced in the factory, right? A can of Pepsi is identical more or less to another can of Pepsi. But if you have an entity with few units or a very diverse set of units, like a custom jewelry maker, every piece of jewelry will be different from the other. You can't really set a standard because every piece is different, right? So it won't apply there. Furthermore, standard costing would not work well in an environment where things are constantly changing. For example, there's a lot of fluctuation in the market regarding your material prices. You'll have to be constantly revising the standard, which is a very costly and time-consuming exercise. And if you don't do that, the standards will become outdated very quickly. So standard costing wouldn't work well in that situation as well. So what that means is standard costing works well in stable environments where you're consistently producing uniform types of products, right? So a manufacturer of something like bricks or paint might be able to use standard costing well, but in an environment which is fast changing, like the tech industry, or where your units or products vary greatly from one unit to another, then you wouldn't be able to use this as well.